Welcome back, everybody. Today we're going to analyze Thermo Fisher Scientific. They make medical devices, and over the past 5 years, they're up 110%. If you invested in this company, you would have outperformed the S&P 500, and maybe we can expect that going forward. Let's take a closer look. They are a $206 billion company, absolutely massive company, and a price to earnings ratio of 35 seems very steep for such a large company, but maybe their growth justifies it. Let's take a look at their financials. Taking a look at their statements, let's look at their revenue growth first and foremost. They have grown from 20 billion up to 42 billion. That is a double up in revenue over the past, 7 years. Um, very good revenue growth. Except for in the past year, they actually declined in revenue. Not really good to see. They grew substantially right out of COVID, probably because of the demand for medical supplies because of COVID. And so, yeah, they grew quite a bit in 2022 and 2021 as well. But now it seems that their growth is slowing and probably stagnating from here. We'll see. Their gross profit has followed pretty closely with their revenue as well, um, except for during 2020 and 2021, they could charge higher prices, and so they had higher gross margins, translating into higher income. Last year, they only had 6 billion in income, whereas a couple of years ago they actually had 7 billion, so higher income a few years ago. They buy back lots of stock as well. So let's take a look at what they're doing. First we'll see their balance sheet. They have $28 billion in net debt. Not really an issue for a business like this, but it is pretty high debt, and we will take that into account when we do our cash flow model. In terms of cash flow, they have what do they do with their cash? Well, they buy back stock with it mostly. They bought back 3 billion in stock last year. Probably expect that moving forward. And they paid 520 million in dividends. They'll probably grow that dividend payment in the future as well. Let's take a look at their stats and see what their margins are actually looking like. Their ROIC is around 7 to 12%, not very high for a company like this. And gross margin at like 40%, 40 to 50%. And net margin, it was 20 during 2020 and 2021, but it has since come down to about 15%. Let's take a look at some of their investor information. So this is what they're guiding for. Found this. They're guiding for 42 to 43 billion, which is growth of 0%, and adjusted EPS of $21 a share. If we look back at their earnings, they're not even close to that. Last year, they did 15.5. So a jump up to 21 would be that would be a lot, but they're using adjusted earnings per share, so maybe they're not accounting for everything. I think it's kind of steep. Most likely they'll probably hit like 16 or 17 in earnings per share next year, especially since their revenue is not going to grow at all. Here's their segments. So they've got life science solutions is most of their revenues. Well, no, actually, laboratory and products and biopharmaceutical services is most of their revenue, right? This is revenue. Yeah, revenue. And how does it translate into income? I thought I had that. Thought I had it translating into income, but I guess not. Okay, never mind. Yeah. But yeah, you can see the different segments that they have and how they've grown in the past year. Their life science solutions is down, and so are their laboratory products are down. But their analytical instruments are up a little bit, and their specialty diagnostics are about flat. Let's take a look at what the analysts have to say. First, we're gonna check statistics and make sure that they're not heavily shorted. And their short percentage is only 0.68, so that is a massive green flag. Yeah, that's very low short percentage, so that's good to see. And taking a look at the analysis, let's see what the analysts are projecting. The analysts are basically just taking the guidance of 21.5 and applying it to their to their projections. And then going into next year after that, they're projecting like 10% growth, which seems really high. And also for revenue, they're projecting 7% growth after next year. I plugged that stuff into the DCF model. Let's take a look at that. EPS estimate here, I put the revenue estimate here. Buybacks of 3 billion, that's what they've done last year. Net debt of 28 billion, that's what they've got. Discount rates of 10% because I want a 10% return on all of my stocks, and an exit multiple of 20. I feel that that's fair for this business since it has a runway for growth. It probably has a pretty decent sized moat. It probably's got like a billion patents. I'm not really sure, but they make medical devices, and usually you get patents for that type of stuff. So maybe a higher exit multiple would be better for this business, but I don't really see them growing like massively from where they're at. They already have tons, like very high revenues, and so I'm not really sure how much more they can expand into the medical devices market. They're probably already pretty saturated in that market, so that's why I think an exit multiple of 20 is fair. In terms of their earnings growth, well, I put the earnings per share estimate here, which I thought was actually really high. I think it's going to be more like 16, but I used it anyways, and the analysts are actually projecting 10% growth after that. So I'm using the analyst projections here. So don't worry, they're not my own, but usually you'd expect earnings growth to taper off, be more in line with inflation. So that's why I put 8 and 5. And in this case, then their fair share price is going to be about probably like somewhere between these two numbers because you have to account for debt, but also debt's not that dangerous most of the time. So probably their fair share price is probably like $400 a share. With them trading at 542, they're overpriced at this time. And same with the revenue model. The analysts are projecting 7% growth into 2025 and a profit margin of 18%. That's kind of what they're projecting in terms of their earnings. So that's what I put there, 18%, even though they did 15% last year. And not quite sure if they're going to be able to get back up to 20 because 20 is what they got during the pandemic. So it might be difficult for them to get back up to 20, but even with this 18% margin, which is pretty high, and a 5% revenue growth, which also I think is generous. Well, actually, you know what? Maybe they could. I think 5% is pretty accurate. They might be able to do a little bit more. Maybe they'll do a little bit less, but I think 5% on average makes a lot of sense. And in this case, then they're worth like $360 a share. So yeah, massively overpriced at this time. They really ran up a lot in the past 5 years, even though it was a lot of multiple expansion, and that's the reason why they ran up so much. And at this time, I think they're just overvalued at this moment in time. And the only reason why people buy it, I think, is because it's perceived as a safe stock. Like nobody's going to come and eat their lunch, basically. And you could probably ride this stock forever, and it would never go away. So um, there's not a lot of business risk with this stock, and that's probably the reason why it's priced so high. But this is a stock that I would personally avoid, just because I don't think you'd be seeing high enough returns moving into the future. I think if you bought it today, you'd probably be expecting like a 6% return. Yeah, maybe like a 5 or 6% return. You'd probably be expecting if you bought this today, which still is about the same as bonds right now. But yeah, I just think that there's better stocks in the market at the moment. So yeah, that's the conclusion for this one. I hope you guys enjoyed. If you did, hit that like button and leave any comments in the comment section if you have any criticisms, and I'll see you in the next video.